I'm going to start with a market update. We'll try to keep it brief, but I would like to level set and give everyone some historical perspective to put in context the conversation. The whole business securitization market in the U.S. started in 2006 with the Duncan Brands LBO by Bain, Carlyle, and Lee. That was followed by several other pre-crisis transactions. Before the crisis, there was a little under $7 billion of outstanding WBS across a handful of deals. Like many structured products, the market closed for WBS in 2008 through 2010. But unlike certain structured products, the reason why the market closed was not the collateral performance. These deals performed extremely well through the crisis. It wasn't the companies, it was actually the investors who went away. Those pre-crisis deals all had bond insurance, and without the AAA rating, there was no natural investor base for the product. Some very smart investors noticed that these deals were performing and they were trading at steep discounts. They started to buy them in the secondary market, and that began really the creation of the modern WBS market, where issuers could access real money. They could sell their deals without bond insurance and access cash accounts. Starting at the end of 2010 with the transaction we did for Adams Outdoor Advertising, the whole business market reopened, and that paved the way for the restaurant issuers to follow. It started small with the Church's Chicken transaction, approximately $250 million in February of 2011, and then it grew steadily from there with Sonic Drive-In, $600 million. And then eventually, really the bellwether transaction was the 2012 Domino's securitization, which was almost $2 billion in size. The pattern continued, and I think much to many people's surprise, the market is now almost 3 times as large as it was prior to the crisis. There's over $20 billion of outstanding whole business securitization paper, more than $6.5 billion issued this year alone. That $20 billion has a weighted average life in the aggregate of approximately 5 years. Since issuers refinance their deals approximately 12 to 18 months before the anticipated repayment date, that means that investors could expect a steady stream of issuance in the asset class, roughly $5 billion per year, putting aside taps that issuers do as EBITDA grows, as well as new entrants to the market, both in restaurants as well as other asset classes. Within the non-traditional ABS space, WBS has become the most significant sector, becoming among the largest sources of BBB rated exposure in the structured products market. So what's driving this growth? Why is the market growing so quickly? It's actually pretty interesting if you compare it to the overall ABS market, which is having a great issuance year, but prior to this year, the overall ABS market was hovering at around $200 billion a year for the past 5 years. At the same time, the WBS market was growing at a double-digit compound annual pace. With benchmark rates low and with spreads tight across corporate debt and other structured products, investors are looking for other places where they could find attractive sources of risk-adjusted yield. What they found with whole business securitization paper is it's one of the few areas and the only sizable area where you can get BBB exposure that's senior in the capital structure. These deals are not the originate to distribute model of securitization. Investors take comfort in the fact that sponsors have significant skin in the game. In many cases, more than 50% of the value of the assets is retained by the issuer and subordinated to the securitization debt. There's significant excess cash flow and over-collateralization. On the recent Duncan Brands transaction, just to take one example, you could remove 55% of the cash flow from the trust day one without breaking the bonds. You could remove 11% of the cash flow every year compounded for 7 consecutive years without breaking the bonds. When you compare that to the historical performance of these companies, Dunkin' being one example. Over the past 20 years, they only had 2 years of negative comps, and those 2 years were in the very low single digits. That level of downturn, which would break the bonds compared to the company's actual performance, is a several standard deviation event. It goes way beyond the protection that's typically offered in triple B structured products, which is usually sized to 2 to 2.5 times base case losses. Despite all of the credit protection, WBS continues to offer attractive yield relative to more traditional structured products or corporate debt. That Domino's deal in 2012 came at a 5.25% yield or a mid-300s spread. No doubt that early WBS investors have benefited from very significant tightening. The recent Dunkin' transaction, the comparable 7-year tranche priced at a yield of 365 or swaps plus 165, so 200 basis points of tightening over the last 5 years on comparable shelves. Regardless, even at today's levels, the WBS offers additional yield relative to comparably rated corporate debt or ABS debt, typically 50 to 100 basis points per year, depending on the transaction and the tenor. At the same time, WBS has proven very, very attractive to issuers. Most of these issuers would otherwise borrow in the leveraged finance market, either through bank debt or high-yield bonds. In exchange for moving assets to SPEs, offering investors better security over their assets in order to achieve an investment-grade rating, these issuers achieve a several-notch upgrade versus where their corporate debt would come. For the largest, most liquid issuers, they're probably saving approximately 50 basis points per year versus the bank market. For smaller, less liquid names, it can be 200 basis points or more. We've also found that the product has become more flexible. We've used it in the context of M&A and sponsor transactions. And it's worth noting that while early on the product developed the reputation for being difficult to implement, expensive to implement, by developing a playbook to put these deals in place with more standardized rating methodologies and disclosure, these deals with the right underwriter have become a lot easier to implement. In fact, they can get done in as little as 2 or 3 months, the same time frame that it takes to execute other structured products transactions. So in summary, the product has really matured. It's achieved what I would call a Goldilocks equilibrium, where you have a product that's offering investors attractive risk-adjusted yields and offering issuers a place where they're able to get favorable execution relative to what's available in the corporate market. So with that as backdrop, let me turn it over to my panelists to ask a few questions. I'll start with Alex on the end. S&P recently published an interesting piece talking about how these deals can withstand a significant bite, I think. Just going on the theme of the title.
A big bite.
So maybe I'll turn over to Alex and you could talk through S&P's approach.
Sure. So I'll start with kind of the approach for credit ratings. We actually updated our credit ratings methodology in June of this year, and it was more about increasing transparency about how you kind of get from start to finish and ultimately assign a rating, and more of a focus on DSCR analysis. But kind of the fundamental steps that we take in doing credit here has pretty much stayed the same since we first published this article in 2006. And I think of it as 3 steps. The first is kind of what I call eligibility analysis. So it's, does this business really make sense in a whole business securitization ratings context? And what that means is a few things. The first is, you have a sponsor, a business that currently owns assets. For the most part, we're looking at restaurant systems and owns IP and kind of rights to a brand. once those assets are sold, kind of what's the degree of independence in the ability of those assets to generate cash versus who will become the manager in the transaction. And so a big gating item for us typically starts there. It's, if you see stress for the manager, the entity that currently owns the assets before the securitization, is that going to lead to a precipitous decline in cash flow generation for the business? And so the businesses that we've rated for the most part are franchise restaurant systems. That's deliberate, and the reason for that is because those are literally systems of independently operating assets. You've got day-to-day operations run by franchisees who are separate from the managers of these businesses. So that's a really key point for us. And then the other side of the eligibility analysis typically is we are projecting sales cash flows. That's pretty different than a lot of other asset classes that we look at, where you've got contractual cash flow, P&I on a loan or a mortgage or a lease cash flow, and the magnitude of cash that's going to come in. And the thing that typically disrupts that is borrower defaults. And so here you're really forecasting sales cash flow, and you're typically forecasting it pretty far out into the future. And so we have this kind of second element of the eligibility analysis, which is, does it make sense at an investment grade level to forecast sales going out into the medium and long term? For a lot of businesses, I think the answer is no. Probably the first place that we look is long operating histories. Again, it's not a mistake that pretty much all of the businesses we've rated have 20, 30 plus years of operating history, and that's kind of the first step where we say, prove to me that the brand has been strong enough to bring customers into the store and generate sales through different economic cycles, through different, typically management appointments and C-suite appointments. And the core product has been resilient and a consistent generator of cash. So that tends to be a gating item. Once we get past that step, now the criteria is focused on DSCR analysis, so we'll apply stresses to sales for the system, typically as a kind of multiple of what we've observed historically. And getting a certain rating level will mean you have to have at least X level of DSCR coverage in kind of the worst of times. And higher ratings should have higher DSCR coverage in periods of stress. And we also now make that a direct function of our institutional view about the strength of the business. So we typically will rely on our colleagues in corporate ratings who also follow these industries and say kind of, what's your view of the strength of the brand and the potential volatility in periods of stress? And so the punchline of that is that a weaker business should have higher DSCR levels that we observe in all periods to get the same rating. And then the final kind of step, that will get you to an indicative kind of model-based rating, taking a view of kind of long-term sales cash flows. And then we kind of have what I think of as like a common sense step. You're taking a pretty long-term view in sales, and that's difficult to do. So we have the ability to adjust the rating up or down one notch, kind of based off of the fundamentals of the business. The sales cash flow kind of analysis will get us to a point, but then what do we know about the scale of the business? What do we know about the percentage franchise, which we think is a very good thing because that increases the independence between the management and the assets themselves. And items like that, high concentrations in different regions or franchisees for the systems we've looked at. And that last overlay will get you to a final rating. The article which you mentioned, Corey, really was, and I think we have some by Splash 15, was a kind of historical analysis about what did we actually observe for these businesses in the last downturn. What we found when we actually looked at the data, the 13 businesses that we've rated in the restaurant space, is that sales declines were actually not, as Corey mentioned before, not that significant for these systems, because you think of these businesses as kind of defensive. These are burgers and chicken sandwiches, ice cream. So in 2009, we saw the worst kind of same-store sales decline approach negative 3% and then bounce back to positive the following year. If you look at it from kind of a system-wide sales perspective, so giving credit to new stores coming online, just slightly dips below zero in 2009. So then we can compare that to break-even analysis, and that's kind of what we think of, for thinking about the maximum degree of exposure to risk in these businesses. And we found that on average, you can reduce sales for these concepts up to 50%. On average, it kind of ranged between 40 and 60. And from a credit perspective, principal and interest was still paid. And for us, that says that there's a pretty big differential between kind of what was observed in the last downturn and what these can withstand. Probably the bigger risk is maybe more event-driven. So, obviously Chipotle has been in the news for E. coli outbreaks, and other businesses have had similar issues. Jack in the Box, I think, is kind of an extreme case in the 90s. But even in those situations, you're looking at kind of maximum, sales declines approaching 30 to 35%. So again, kind of going to Corey's earlier point, and the point of the article, even from a historical perspective, even if you focus on what we think is probably the bigger risk of event risk, these structures actually are able to withstand quite a bit more than I think what at least we've observed historically.
Thank you, Alex. Kroll has similarly been very active in the space. Maybe you could talk about some of the considerations and risks in these deals and mitigants, and also touch upon some of the new asset classes that you've been covering, such as in the Coinstar transaction.
Sure, happy to. So a few weeks ago, we published a piece called Food for Thought, and one of the areas that we touched upon and highlighted were some of the sort of challenges for the sector. A couple of things to note. One is just changing or shifting in consumer preferences. Market saturation is another, and of course, people always, one of the things to talk about here is competition from grocers. A few things to note here from a mitigants perspective. Different restaurants are doing different things. So, for instance, many of you may have seen that Chili's, for instance, is reducing their menu by 40%. So that helps streamline the process, speed up the execution, as well as optimize their cost structure. Others are expanding into online and just really beefing up their online presence, as well as increasing delivery. And you've seen a lot of various restaurant chains really get into the delivery system as another way to sort of expand their sales and also offset some of the weaknesses. On the structure side, you also see that from a whole business perspective, the pledge of the assets include not only existing but future franchise agreements, as well as potential for other things to be not just what's a static pool, but also to the extent there's improvements or if there is additional restaurants that are open, the cash flow from those, the royalty cash flows will also be automatically part of the deal. And of course, structural-wise, there are many cash flow type triggers that will help also offset the transaction's potential for deterioration. And to speak to a little bit about other asset classes that we've, as Tori said, the Coinstar transaction was one that we raided earlier this year. It's non-restaurant and also it's non-franchise business. So, but there are some similarities and actually some important sort of essences of what we view as a successful candidate for a whole business securitization. Includes high recurring cash flow streams. You look at the assets, what is being pledged? Is it core cash flows? How close is it to the revenue generation, or is it just companies' profits, which could be exposed to other fixed type of cash flows that are needed by the business to be run that are out of your control, including rent cash flows or wages that are a little bit more stickier, even though there are declines. And also just operating history. It's a very important thing that we look at through various cycles, how they performed. And the transaction obviously has its own challenges, but I think the main construct of the structure was similar to many of the restaurant transactions that we've seen. So all in all, I think it can be leveraged, the technology that is for whole business in other asset classes.
Thank you, Z. The thing that we observed about the Coinstar transaction at Guggenheim was that although it wasn't a franchise business, to Z's point, it had a lot of similar attributes. It was a unit-level economics business with over 20,000 points of distribution. To steal Alex's term, it's a defensive business. It's a business that's based on people converting their coins into cash in order to pay their bills and buy their groceries. It's one that tends not to be cyclical as a result. And similar to the restaurant companies, it had an extremely long history of stable, both same store as well as system-wide sales growth. Although it did require some element of the company operating the business to collect the cash from the machines, it was a fairly automated process with many elements of it outsourced. So we're hopeful that that template will be useful as we find other candidates that have the right criteria to access this market. One point and one theme that I'd like to highlight is to talk about the increasing investor participation in the market as more and more accounts have really listened to what S&P and Kroll have been highlighting in the sector and getting involved. With the recent Dunkin' transaction, we're now at a point where the number of participants in WBS new issue has approximately doubled since the beginning of 2015 when they did their first transaction after the crisis. It's a pretty remarkable growth story. There have been a number of contributing factors. With that 2015 transaction, we introduced the first 4-year tranche into these deals, which appeals to a lot of money managers and more, I would say, traditional consumer ABS buyers versus the insurance companies who've been the dominant players in this space historically. More recently, in the Domino's transaction in 2017, we introduced the first floating rate tranche, which also appeals to another group of buyers that previously was unable to access the market. The results have been over 8 billion of orders for the Domino's transaction, over 5 billion of orders for the Dunkin' Donuts transaction. By any measure, the size of the investor participation in this market has grown significantly. At the same time, liquidity has improved. We looked at the stats recently. In August, almost 500 million of bonds traded across 133 separate trades. That was up 50% versus July, where 322 million traded, over 94 trades. On some of the big shelves, just to give you a sense, in Domino's and Dunkin', over 100 million of bonds traded just in August alone, so roughly 3% of the outstanding issuance in 1 month. I would say compared to other BBB structured products, the liquidity is reasonable. In these tranches, because of their size, you have a huge number of investors, 50, 60, 70 plus accounts in some of these large deals, which really creates the opportunity for better liquidity than other thin BBB rated tranches in other areas of structured products that may be perceived to be more liquid. Another measure of liquidity is bid-offer spread, and these bonds are trading in fairly tight markets. At Guggenheim, we quote these deals in two-way markets, typically 5 to 10 basis points. And if you look on Trace and you average out, where bonds are trading, they're getting done on average maybe 4 basis points. So relatively tight markets, which is another measure of liquidity. Ben, do you want to talk about liquidity and other factors that you're seeing in the WBS market right now?
Yeah, absolutely. No, thanks, Corey. I would say that the expansion in the investor base for whole business securitization product is also correlated with a broader expansion in non-traditional investor product. I think that in general, the themes that you've heard thus far, attractive, risk-adjusted relative value, is one that's really permeated the entire non-traditional ABS sector. And we've seen actually record-breaking transactions in a number of different asset classes. As it relates to whole business securitization specifically, I think that you've seen a dynamic evolve where the availability of product for highly franchised companies is now highly concentrated in one financing source. One of the big themes that we started to see in the Taco Bell securitization, and then we continue to see in Domino's and Dunkin', and even some of the private securitizations that Barclays has done this year for, securitizations of private companies for the likes of Focus Brands and Jimmy John's, is the participation of the corporate crossover investor. And what we've heard from some of these investors is that there are credits that have long been financed in the traditional bank bond market. They're familiar with them. They like them. As you've heard Alex and Z say, the fundamental credit profile of a highly franchised business is different than looking at something from a pure corporate analysis. But all of a significant majority of the credits that had previously been in these markets have now transitioned over to the securitization market. So we've seen a virtuous cycle of investors with limited structured product experience now coming up to speed on the space and on the structures and investing a significant amount of capital in this sector. And with that, I'd say, has come an increase in liquidity. Again, it's a bit of a self-fulfilling prophecy if you have a naturally increasing bid. And we've also seen the street bid for these names improve. So our colleagues at some of the other bulge bracket investment banks are making a very aggressive bid, I think, in this product in an effort, both to get in the space and also, it's what they're hearing from their clients. So, I'm very encouraged by the amount of investor participation that we've seen. I think, we've been tasked by our clients, especially the large benchmark issuers, the likes of Domino's, Dunkin', Taco Bell, to really continue to expand the investor base. And so, our job isn't done, but we're very encouraged by what we've seen so far.
Thank you, Ben. It is interesting to note the corporate crossover bid. Some of the largest orders in the Dunkin' transaction came from new participants in the WBS market. I would characterize these as money managers that have structured products expertise but work together with their corporate colleagues and ultimately allocated the bonds into accounts that don't traditionally buy structured products. So as a result, that's driving significantly more liquidity in the space. Let's turn to the legal side. There's some interesting recent developments regarding the monetization of IP in the leverage finance market, and it's worth noting how they contrast with the requirements of a typical WBS deal.
Sure.
Michael, do you want to comment on?
Sure. Thanks, Corey. So that's kind of a nice segue from the corporate crossover investor. I think the legal structure for these deals, the core structure now, has been pretty steady since really that 2012 Domino's deal that a number of folks worked on in the room. And I think more of the development has been, what new kinds of applications can there be? How do you use it in certain acquisition contexts, that sort of thing. As more and more investors come in, we've had a couple situations this year where our clients have been insurance companies doing private placements in similar spaces. And as you explain to those investors how these structures work, some of these conversations come up. about the legal structure that, that we all designed a long time ago for structured products investors, but we're having to sort of explain it again for some new folks. On the Taco Bell deal in 2016, that was an interesting deal because Yum Brands at the time was not only doing a securitization of Taco Bell's franchise royalties, they were doing a parallel bank bond structure of KFC and Pizza Hut at the same time. All of that lived under a senior unsecured indenture context that had been around since the 90s, right? So in order to structure this franchise WBS, we had to make it work inside, regular way leverage finance covenants, existing 1990s bond indentures that happened to be around. And the crux of that transaction resulted in our ability to move that Taco Bell IP into the securitization subsidiary, which is basically what we do on every single one of these transactions. We take the Crown Jewel brand IP, we move it into an IP holder or another SPE, and then we put the securitization overlay on top of it. So fast forward to earlier this year, as those of you who watch the leverage finance market as well probably noticed there's been a lot of talk around companies like J.Crew and others who have very monetizable, very well-known IP, but they had traditional capital structures. And so in that transaction, they moved the IP into an unrestricted subsidiary, and there's been a lot of press around about, in particular for retail companies, what kind of flexibility should they have to move their IP? And the reason that I'm bringing this up today is that a lot of folks in the leverage finance market are starting to make comments, and we're seeing comments coming out of the banks, that on day one for certain companies will lock down their Crown Jewel IP. And so we've seen covenants like, you can't move, Crown Jewel, or they'll have some definition of the IP. You can't transfer it into an unrestricted subsidiary without lender consent, et cetera. So I think that especially issuers that are looking down the road to doing one of these franchise WBS transactions should think ahead, because if you've got a senior capital structure that has significant restrictions on your ability to move IP or other assets, it may make it more difficult to do one of these transactions inside your existing capital structure. Lastly on that, I think one big theme in the legal analysis of these deals over the last few years has been, as Corey and Ben have noted, the product is getting more ready to structure. It's more easy to structure. You can get them done in 2 to 3 months. A lot of that is because a lot of the transactions are shifting to what's called a royalty-only structure. So we securitize the franchise royalties and we charge a synthetic royalty to the company-owned stores, but we don't necessarily transfer in all of the company-owned assets. I think the big developments on the legal front are going to be, how do you, especially if you're working inside an existing capital structure that's broader, how do you write your covenants broadly enough such that you can transfer in those company-owned stores in the future, so you can transfer future assets. A lot of the recent transactions, in particular some of the multi-brand transactions that we've done this year, have some very flexible ideas on how do you get new assets in, how do you get old assets out, and how do you change the mix of brands in these deals over time. So really, I think that's what's keeping the lawyers excited these days, is how do we make this product more flexible, how do we make it fit inside a broader capital structure, but then still keeping the key rateability of the transaction.
Michael, what are the key legal issues about contributing company-owned stores? So
the company-owned stores, as everyone knows here, for these franchise businesses, oftentimes they have a large portion of their pool which are franchise stores. So there, if I have a brand, I go out and sell Ben a franchise, and he runs the store and he pays me a royalty every month. But a lot of them have 30, 40% of their portfolio that's actually company-owned locations. So the company actually manages the location itself. A lot of the transactions have those in the deal. Going back all the way to some of the earlier deals, they've been in the transactions, and they frankly have been one of the things that slowed down the structuring of some of the original transactions, because if you've got thousands or hundreds of company-owned locations, that means you've also got thousands or hundreds of landlords. And just from a legal perspective, one of the biggest processes that you have to go through is figuring out a way to actually transfer those company-owned restaurants into the securitization, which invariably, in many cases, involves transferring a lot of the leases. And that involves landlord consents, which can take a lot of time. Over the years, folks have gotten better about that. There's people who've used specialty, real estate sort of landlord negotiation firms, which have worked pretty well. A couple of recent transactions have had some structural solutions for kind of adding some optionality to that process. But that's something that, again, that the lawyers are thinking a lot about, is how do we further streamline that process of, in particular, dealing with the landlords and other, sticky cash flows. Because I think that's important. We're talking about restaurants today, but, I think everybody up here wants to expand this product into different asset classes and different issuers. And as you move away from businesses that are purely a franchise contract model, you start having stickier relationships, you start having more contracts with vendors and third parties, and legally, the easier it is to move those and get those into your structure, the more this product is portable to other asset classes.
Yeah, one other thing I would say on the company-owned store point is you've also, in some concept, or depending on where company stores are, may need to deal with moving employees actually into the SPE, which introduces a whole host of complexity, and in some ways is a little bit counter to what people traditionally think of or securitization should be, which is the passive reception of, at its core, just holding a pool of self-liquidating financial assets. So, as we go forward, I think it's going to be interesting to see how close you can sort of walk the line, because taken to its extreme, at the end of the day, all you might be doing is adding some legal structure to what is a normal down the middle of the fairway operating company. At that point, you got to ask yourself, is securitization really different? Is the risk really fundamentally different?
On the company-owned store point, I think it's important to note that because it's now been done several times in the CKE transaction, for example, but most recently in the Five Guys deal that Guggenheim did earlier this year, the structural issues are known and there's a game plan to deal with them. So I wouldn't describe it as a barrier to pursuing a transaction. It's a consideration that needs to be thought through and structured around. There's a matter of degree. If it's 100% company-owned system, you probably won't achieve the leverage that you might otherwise be looking for in this market. But one important aspect of these deals is that they're customized to each particular company. So in the case of Five Guys, one interesting element of that business is that it's in early stage growth mode outside the U.S. So we proactively structured the deal to include dividends received from the international business as part of the cash flow stream, but not burden the U.S. securitization with the costs associated with growing the business outside the U.S. That was in addition to including the company-owned store cash flow in the deal. As a result, they were able to achieve a transaction that optimized their leverage, maximized the debt service coverage that investors were provided as part of the transaction.
Maybe one more comment on the company-owned from a ratings perspective. Kind of going back to the original point, there's a bit of a trade-off, I think, from a credit perspective as it relates to higher levels of company-owned stores. Company-owned stores, you have direct kind of credit exposure to the sponsoring company. So from our perspective, going back to that original eligibility analysis and kind of the independence of the assets from kind of the sponsoring company or manager, are a little weaker. But in a lot of these structures that have, not all, but a lot of the structures we've seen with company-owned stores, you have, I think, as Michael pointed out, a synthetic royalty. Sometimes it's higher than the royalty for the franchisees. And then in a lot of cases, you have additional EBITDA cash flow pledges. So sometimes from a cash flow perspective, you get pickup, which obviously, our analysis is a function of cash, but then the offsetting factor, again, from just a credit perspective, is maybe higher relationship with the credit profile of the sponsoring company.
Something else that Corey brought up I thought that was interesting on the international was, one thing that I think is great about this product that a lot of folks up here, I think, appreciate as well, is the optionality of the product and the fact that over the years we've figured out just to be able to get just about any kind of cash flow that one of these restaurants companies would have. We've put in, other products and services revenue where if say you're selling Arby's branded curly fries in the grocery store, we've got that in there via licenses. But, the international is very interesting because a lot of these companies, Five Guys included, have very sophisticated international tax planning strategies. And in order to be able to structure that on top of the securitization tends to be different for each company and highly customized. And the banks are all very good at working with the issuers and coming up with those structures. On Five Guys, it was very interesting because, as Corey noted, they're in growth mode internationally. It's still a very small portion of their business. So we did it in a way that was very optionalized, very, at this point, just kind of circling the dividends back through. But in the future, they have the ability to put in more and put it in a more defined rubric. And so I think the flexibility that this product has put in play, in particular in the multi-brand context and the international context, you don't have to think of it as a pure play. You've got one sandwich brand in the U.S. kind of model. It really has been used in, I think, just about every different kind of category in the area these days.
Yeah, I would also add, there's a little bit of feedback, hopefully everyone can hear. I would also add that despite the fact that the deals are customized, they've also, at the same time, become standardized in many ways from a disclosure standpoint, from a reporting standpoint, from a modeling standpoint, which has helped liquidity, particularly for the public companies, which I think are very good about making information available to investors. That level of standardization across deals helps investors figure out more readily what's different about each transaction so that they can develop views on relative value and where the transaction should trade. With that, we only have a few more minutes. Maybe I'll open it up to any questions from the audience.
Go.
Evan?
So maybe two quick ones. Two quick ones. So maybe first, just on the legal side, I'm just curious about the precedent, being set historically in terms of the bankruptcy remoteness and the first priority interest. And I think some of us are probably familiar with the local Insight Media, which had some outside debt, and again, it sort of looked like that held up. But any sort of comments there? And then the second one, just for the rating agencies, just curious how you guys think about downgrades when performance does kind of, cash flows come in a little bit, maybe weaker than anticipated. And as different entities kind of approach those triggers, it seems like different agencies have taken different tacks in terms of whether to downgrade those bonds or not.
Michael, you want to take the legal point?
Yeah, I'll take the first one. So Corey and Ben actually are much more familiar with local Insight Media than I am because I didn't work on that transaction. But just generally in the structure,
I'm not sure I want to own that one either.
but generally in the structure, it's taken a lot of feedback over the years, and in particular the sort of reboot of the structure after the financial crisis when the monolines were no longer involved. The introduction of the servicer and the backup manager in the roles that they're in today. It's basically structured like a prepackaged insolvency, rescue team. There's when regular way companies go into some financial distress, oftentimes you'll get an FTI or an Alvarez and Marsal or somebody like that to jump in. These deals have all those mechanics basically built in. There's a backup mechanic that, as certain performance triggers decrease, it's kind of a canary in the coal mine, and the backup manager starts to spin up and have more action and more active involvement in monitoring. The idea being that a transition plan would be formulated and implemented prior to any kind of parent insolvency. So even if the non-consolidation and the legal structure has challenges on the back end, you've been in a situation where the structure in the deal has been planning for that ahead of time. And so people get comfortable for two reasons. One, it's legally structured with all the usual true sale non-consolidation structure that you have. But then also at a business level, there's this overlaid sort of prepaid, pre-planned insolvency consulting mechanic structured over the deal with people like Midland, FTI, Alvarez, and Marsal. Those folks ready to go at a moment's notice as the deal begins to deteriorate.
And the other thing I'd say on that is that, for the majority of whole business securitizations, it really is the only debt in the capital structure. So when you limit the number of creditors potential creditors that you have, any additional debt, and these structures do allow for modest amount of additional debt to go outside the securitization, although usually they're pretty heftily levered within the securitization. I would say that that's a significant mitigant.
And let's
where there's no pre-existing debt, it's hard for somebody who lends money to the company later to say that they legitimately had a claim on assets when they were unnoticed that the assets were in a bankruptcy remote entity, secured with a first priority claim.
Yeah, there's actually a...
to another lender. But just quickly on local insight, and we could spend more time after the panel. It is one of the few deals I didn't structure, though I'm relatively familiar with it just from dealing with some of the fallout later. There was a separate silo called Regatta that filed for bankruptcy that was managed by the same entity. And it's my understanding that there were various times during the Regatta bankruptcy where there were attempts to drag the local insight media and recut the contracts between the two entities. But the legal structure survived. So while the Yellow Pages story is not a good one from a credit standpoint, the local insight case, I think, is actually good precedent in terms of the integrity of the legal structure.
Yeah, and one point Corey was getting at that's a good one is that the last thing that these documents have is that if you do go incurring a lot of debt outside the securitization, once you get over a certain amount, you actually have to get the creditor to sign what's called a non-disturbance agreement. So they have to acknowledge formally that the securitization is there, that they won't challenge the structure, that they're junior to it, and that piece of paper actually gets entered into with the new creditor.
With that, and because we only have a couple of minutes, I think the downgrade question is a good one. So maybe if Z and Alex.
I guess I can start. So there's periodic surveillance that's performed on each of the transactions. Obviously, we get monthly data with regards to, you get to see trends with store counts, AUVs, and other cash flow that's pledged to the deal. So to the extent we see any trends that are forming, we will also be doing deeper dives and looking at the analysis, including running the gamut of various cash flows that we would do, including those that are described in the pre-sale. So those are things that we would look at, but to the extent that there's a sizable amount of deterioration, that's something that we will definitely note.
Yeah, a real case study in that is we had recently put Iconics, which is it's not a restaurant concept, but it's royalty cash flow from a portfolio of brands on credit watch negative. And the reason for that was we had seen since closing kind of deteriorating DSCR levels, just weakness in retail, right? And there had been a number of sales, which you're paying off bondholders, so there were offsetting factors. We've been watching that for a while, and at a certain point, we'll put something on credit watch negative if we think that really kind of the deep dive needs to happen. And so we're always, as Z said, monitoring, for the restaurant system, same store sales, AUVs, what's going on with store count. You can even, I think it's just smart to Google, these businesses periodically and see what franchisees are saying. But there's a threshold, and, that can be a function of debt service coverage ratios or other metrics where, we will put things on watch. And that actually was resolved on Friday of last week. We thought that the paydowns were sufficient, that the rating still made sense at the existing levels.
One question actually for you guys. Would you say, though, the structured finance ratings are meant to be relatively stable versus say a corporate high yield rating, which you'd otherwise see at the same leverage level?
Yeah, I'm happy to start with that. So, we have criteria called credit stability criteria. And so, in my mind, a key differentiating factor between investment grade debt and non-investment grade debt is you shouldn't have as much cliff risk in terms of the performance. That's kind of the threshold. And the way we think about that is investment grade ratings really shouldn't migrate, in high periods of stress more than 3 rating categories in 3 years. And so, when you're looking at non-investment grade or high yield, you can't necessarily make that statement. And so that's a big part, again, of our kind of early analysis about does this even make sense at an investment grade level given the fundamentals of the business.
And when you have 3 times, 4 times, 5 times debt service coverage in these transactions, they can withstand quite a bit of moving around before it would warrant a downgrade. It looks like we're already into overtime. Thanks to the panelists, great discussion. Thanks to everyone in the room. I love the standing room only audience. And thanks to the conference organizers for giving us a primetime slot. Appreciate it.